Hey everybody, it's Pete. Welcome to Stocks for Breakfast. We have a ton of stuff to talk about today. I think probably the biggest thing is Nvidia earnings, but the market hitting all-time highs. The stock market just kind of has nothing in its way right now. We're going to map out, again, if you're new to the channel, what we essentially do is we kind of map out the landmines and the potential opportunities going into this week for swing trades, new swing trades we're setting up, as well as trade management on existing ones. But I got a big thing I want to talk about today, which is a book that I just finished reading. Just completely shocked me. I can't even say it any other way. It's this, and I'm going to actually kind of work our way over to there really quickly because we're going to come back to it. But if you've read this book, Principles by Ray Dalio, you can see over 5 million copies sold. Boy, it's probably one of the most interesting books that are out there. I believe it was printed, 2017. $140 billion hedge fund managers, some of the most successful runs of anybody in a long, long time. And the book Principles, basically how they run the company, for lack of a better way of putting it. It's kind of a set of rules for the company. If you read that book and you have this lofty, unbelievable view of Ray Dalio and Bridgewater and the accomplishments and everything like that, you're not alone. But I challenge you to pick up this book because it is the complete opposite of what Ray Dalio and everybody talks about in that book, and especially the Principles perspective of how the company was run and how the principles were supposed to be this governing way of everybody having an equal way of providing feedback to the entire company. This has nothing to do with Ray Dalio. It has to do with the two books. If you read Principles and you want to get something, this is a really interesting read by Rob Copeland. I read it in basically like 4 days. That's how good it was. I couldn't put it down. So if you love the markets, you love this kind of stuff, you love hearing about a gigantic, gigantic hedge fund and kind of what goes on behind the scenes, this book is fascinating. So let's translate that and move on into what we have going on this week. So again, if you're new to the channel, what we like to do is set up the week. So we're actually going to kind of talk about first the market resting and closing, the Dow Jones Industrial Average specifically getting over 40,000 and closing there. It hit it on Thursday, closed above it on Friday. Now, the challenge that we have, and for some reason, all-time highs and breakouts and those kinds of things get some pretty bad publicity because everybody sees blue skies above and nothing in the way. And then when those trades break out and fail, everybody starts yelling breakouts don't work, right? Especially all-time highs. But again, you really need to keep in context that all trading is going to have losses and it's going to have profits, right? I want you to know this right from the beginning, that there's no business on the planet that has zero expenses, and trading expenses are your trading losses. So the cost of running business. So if you told me right now trading breakouts is the only strategy that I can have, which obviously we're looking at right now with the stock market at all-time highs, I'll be perfectly okay with that because we have this quote. Again, this is a posted pad moment. Write this down. Real breakouts follow through. So they tend to have a really skewed win-loss ratio where the losses are small, but then when the wins follow through, they're gigantic and they're really, really profitable. So I just want to walk you through one that is kind of setting up this morning that is pretty interesting. And actually, it started from last week. Dell exploded through here, right? So you can see we got some pretty clean price action vaulting through that, what a lot of people would know as a triple top. Well, we have an interesting one here, and I'm going to show you why this one is pretty interesting to me today, too. Microchip technology. It's actually sitting, if we kind of zoom out here a little bit further, you can see it's actually sitting at all-time highs, right? But what's more important, and this is probably something, one of the biggest things I believe that really can help. There's really no other way to put it. And by the way, everything we talk about here is for educational purposes, right? It's up to you to make that final decision. It's my mission to kind of help you make better decisions. And that's kind of what I want to talk about right now. Anytime we're looking at a new trade, it's our job to stack the reasons why we would choose to accept risk. Now, a lot of people get kind of caught up in the prediction paradox, right? You get stuck in this thing where you think you need to predict what's going to happen next. And boy, that is a really, really challenging way to make a living, especially in the markets. The way that we do things, it's a lot easier to say, what is going on now? What are the odds of it continuing? And how do I know when that changes? So none of that is predicting. So I want to go back to that second part there, which is how do I know the odds of it continuing? And that's what we kind of call stacking the reasons, building the argument into the trade. So if we're talking about MCHP and specifically going down into technology and specifically going even deeper into semiconductor stocks, we're kind of building an argument. So if we work our way over and take a look at what's going on in the bigger picture of the market this week, in sector rotation, we can actually see that technology, as of last week, kind of launched its way all the way up to the top, and actually pretty good across 5 days and over the last 4 weeks, which is roughly a month, right? So 7%. So it kind of worked its way all the way up to the top. Now we kind of want to work our way through that even deeper and say how many other stocks in that sector are doing well. And we could start to see that there are some other stocks with bullish stacked order flow, right? So if we kind of work our way even deeper into that, into sector rotation, we can actually see that this is the big one right here. 80% of technology stocks traded positive for the last 3 days. Now, I want to kind of give you this. I want to kind of spur your passion for the markets in just a little bit of a deeper way, but keep it simple, right? If we have 100 stocks that meet, let's say, criteria happens to be when I'm looking to set up swing trades, I want them to have a minimum 1 million shares per day average volume. So that means that there's liquidity and there's institutional attention. Institutions push the market around, right? Institutions move the stock market. We should pay attention to the stocks that institutions trade on a regular basis, right? The other thing is average true range, which is volatility. Volatility, average true range, is basically how much the stock moves from the low to the high on an average daily basis. And that's basically giving us institutional attention and opportunity. When you match those two things together, those are the stocks that you want to go and take a look at because there's opportunity there, right? So 1 million shares per day on average true range of at least $1, $1.50, even a little bit higher than that, but $1 is okay, right? So what we do is, let's say we have 100 technology stocks that match that criteria. Now, what you might be doing is maybe you might be saying Nvidia is popping or AMD is popping or whatever stock it happens to be. Nvidia is important, right? And we're going to talk about Nvidia in a second. It has earnings this week. But what we want to know is, out of all of the technology stocks that meet that criteria, how many of them are trading positive and how consistently are doing that? So what we run behind the scenes is we run these scans that are basically proprietary, tell us over the last 5 days, what percentage of stocks in each sector are positive versus negative. So I want to go back to what I said before, which is stacking the argument, building the reasons that we would choose to accept risk on a trade. So in other words, what's the likelihood of earning enough money versus the risk we need to take? Let's boil all the trading down to that, right? Everybody knows risk reward, but what a lot of people do not talk about is what are the odds of the reward being reached versus the odds of the stop loss being hit. Now, I want to be clear. I want to keep coming back to this because this is really important. Odds mean likelihood. Odds do not mean definite. That's very, very important. And the sooner you accept the fact that all trading is about one thing, stacking the odds in your favor and what is probably going to happen next, and then taking the correct initial position size in that particular direction. Some stocks are perfectly sitting at a breakout level or have paused for a few days after rallying pretty hard. We call that the optimal entry. So I want to be clear because we get some comments once in a while on YouTube. You talked about a stock last week that went down. That's fine. That's a part of what we do. Some stocks lose money, some stocks make money, but the problem that a lot of people have is they kind of hang on to the losers too long when you should be learning how to hang on to the winners as long as possible. So remember, never beat yourself up if a trade you liked and really put that trade together and had all the pieces that you could have possibly wanted. If that trade should happen to not make money, it doesn't always mean you did something wrong. It just means that a part of the edge, that one particular trade didn't follow through. So it's super important to understand because when you have a systematic way of making money, you're relying more on how all of the trades work out together, as opposed to just the one trade, which sometimes is kind of like that spur of the moment idea, right? So I want to go back to stacking the odds in technology stocks right now. It's one thing that they were up one day, right? But if we kind of work our way into it a little bit deeper, and as I said here, 80% of technology stocks traded positive. Now, this is really what we want to take a look at right here. You can actually see what we do, which is called stacked order flow and over time. So what we're really looking for is which sectors are trading positive on a rolling 5-day period from a percentage perspective. So in other words, this is 83% of financial stocks. This is negative 54% of industrial. So even though industrials hit new highs last week, they've started to lose bullish momentum. So these are the kind of things that you notice when you put these metrics together and you start to manage your profitable trades a little bit differently. So if we could take a look at, let's say, for example, these industrial stocks, they might still be going up. But when we run these kind of proprietary numbers behind the scenes, we're like, wow, they're still going up, but they stepped off the gas. We now have 2 days of negative percentage for industrials. So what that would mean from a trade management perspective is we would notice that. So let's say Simon, hey, Simon, good morning, pal. Maybe Simon's in General Electric or whatever it happens to be, 3M, which has actually been pretty strong recently. He wouldn't necessarily get out of the trade. The proper thing to do is to sit up and say, okay, something changed in this group of stocks that I really like, and I'm going to move up my trailing stop loss closer because the conditions have changed. And this is kind of the way where you build these arguments and you start to say, I know what I'm looking at, and now I know what I'm supposed to do. That is incredibly, incredibly different from saying, where do we think this is going to be a month from now? Nobody knows where it's going to be a month from now. Nobody. If you doubt that for a second, start collecting headlines of every major place that you can see. One's going to say the stock's going up. Another's going to say the market's going down. They're all over the place. It's great to have ideas, but I want to make this super clear to you right now. It's much, much easier to trade in a systematic way where you say, this is what's happening right now. How can I build reasons to believe it's going to continue? But more importantly, how do I know when it changed? So when I just talked about this here with industrials, you can see that the story changed a little bit. That's important. And that's the stuff we need to kind of notice. So technology right now, for the better part of the last week, has started to increase, and the number of technology stocks, which is a different metrics that we run, which I'll show you over here, work our way down. This one is just the raw number. And if we work our way over into technology, you can actually see that these numbers have increased dramatically. So this one is the number of stocks. We went from negative 15 and now all the way up into the 130s and 140s. So technology is clearly what we would call catching a bid. Now, I want to be as blatantly clear about this as possible. What we're trying to do here is we're looking for clues. We're looking for clues to say, I want to be a buyer of certain stocks, and how many reasons can I find to do that? So if we kind of work our way backwards now, we start to move up into individual stocks. Well, which stocks are strong? Which stocks are breaking out? What industry groups inside of technology has that? We can say the same thing about real estate stocks right now, which have also been pretty strong. And actually, I can show you one that's kind of working its way up our list right now and has been working its way up the list, Welltower. Now, Welltower is a little beyond what we would call an optimal entry, but it's going to be in my list. I am essentially looking for a pause like this before I look for the next move. But what's important is to have these stocks in your tracking journal. So I want to be clear about this. The easiest way to be a consistently profitable stock trader is to do it in a systematic way. And what we're talking about here is I look at the same metrics every single day, and I'm looking for clues. The more clues we get, the increase in conviction just keeps going higher and higher. Now, that's the positive side of the ledger, right? We just talked about the Dow Jones Industrial Average hitting 40,000, the S&P 500 hit new highs. All that's fantastic, right? The blue skies above, and let's kind of map out the week that we have going forward, and we'll kind of add earnings into this equation, right? So if we kind of work our way into this week, Palo Alto is actually pretty strong. We're going to talk about this in a second because there's 3 stocks in that sector that I like that have started to turn around, and they trade very, very well together. But Nvidia is obviously the big dog that everybody is going to be watching. Now, what's super interesting about this is the fact that the stock market is rallying into these new levels without Nvidia, which has obviously been the big dog for the entire year. And now the stock is kind of pausing. Now, the one thing I will say is if you happen to be trading Nvidia, there's actually a way of using the options market to calculate the expected move that Nvidia is supposed to have, which Nvidia is scheduled to report Wednesday after the close this week. So essentially what the options market is saying right now about Nvidia is it's looking at roughly a 9 to 10% move after they report. So if you happen to have a swing trade in Nvidia right now and you're looking or trying to make the decision, do we hold this into earnings? Now, the way that we do it is we take a look at, and this wasn't created by me, John Napolitano, our Options Trading Pro introduced it to me, but I want to share it with everybody. You're essentially looking at roughly a 9 to 10% move. So if you happen to have a losing trade in Nvidia right now, you have to be thinking to yourself, the stock is $900, a 9 to 10% move right now, that could be a $94 move in the other direction. So you need to really be thinking to yourself right now, do I want to expose myself to that kind of volatility on a trade that's not even winning at this particular point? The other side of that is, do you have a 10% win or a head start on Nvidia right now, where the worst case scenario, Nvidia would come back to your entry point. Best case scenario, you get that 10% in your favor. So there's a lot to think about on earnings right now, especially with the stock and so much attention on the stock. I truly believe that this is going to get that 10% volatility, if not more. Apple actually had a bigger move than that than was expected. Walmart, which just recently reported, had a bigger move than what was expected. So that 10%, the way the market's trading off of earnings right now, is probably a little bit on the conservative side. So if you, again, this is kind of the planning that you really want to do. And again, I want to separate trade from investment. You know, a lot of people talk about Tesla and whether or not Tesla is a good trade versus they love Elon Musk and they just love everything about Tesla. That's very different from a trade. A trade is a very specific moment in time where you aligned risk reward on a trade. You said, I'm okay with accepting this kind of risk in exchange for the reward that I believe is on the table. And when you did that, you had an edge. You had a strong conviction based on building that argument that at that moment, the risk was okay because at that moment, what the reward was likely. So now heading into Nvidia, you have to ask yourself, is my edge still valid heading into earnings on Wednesday after the close? If the answer comes back yes, then you're still in good shape from a trading perspective. If you come back and the trade is negative and you're not sure, you really have to do some soul searching and really think about whether or not you want to hold that with the expected volatility, because of how many people in the market are waiting for this earnings to come out to either catapult the market to fresh all-time highs and technology continue to push it forward, or be kind of a warning sign that maybe the AI mania has cooled off a little bit and we have to start to look other places for bullish ideas. Now, the good thing about the market right now is market breadth has improved. Now, what market breadth means is basically there's a larger number of stocks that have bullish stacked order flow. So in other words, it's not just the Magnificent Seven stocks. It's not just semiconductor stocks related to artificial intelligence. The amount of money that's going throughout the market into different sectors has spread, which kind of builds a little bit of a stronger foundation under the idea. If you remember when we were trading and watching the market during this rally over here, the big argument against this rally was that it was just the Magnificent Seven stocks, and that kind of made a lot of people nervous, which is quite honestly a whole other argument. But what's more important, the fact that it's going up every day or it's being supported by just those seven stocks? That was the downside argument, or the be careful argument during that 22-week rally. We don't have that as a problem right now, which kind of really, again, looking for clues into the market. When the market breadth is wider, there's less prone to being shocked by one stock. So obviously with Nvidia coming out this week, it's going to affect the market. But with so many more stocks showing relative strength, showing bullish stacked order flow, I believe it's going to have a less negative effect because of the amount of stocks that are strong right now. Now, I'm not saying it's going down. What we're doing is we're building safety into our trades by mapping out every possible thing that could happen. So Nvidia is a big part of this week. Now we're going to take a look at economic numbers because we kind of look at, are there blue skies ahead for this week, or are there kind of landmines or really important things happening from an economic perspective that might make us lower our initial position size until they're out of the way? So recently, obviously, we had jobs report, which was pretty darn good. Last week, we had inflation numbers, which the market liked again, which also that's a big thing right now, too, which is kind of interesting. This is the first economic data, and then this is another one from last week, right? The S&P 500 has had 5 bullish gaps in the last 10 days. That's a lot. Now, for those of you that aren't familiar with what a gap means, a lot of people mistakenly believe that in stock market, a gap is a open that's higher. That's not the case. So I'm going to actually use this as an example. A gap means that the stock opened above the previous high or opened above the previous, opened below the previous. So open up here or open down here. A higher opening doesn't mean a gap. It has to be outside the previous day's trading range. So the point that I'm making is the fact that we got 5 gaps to the upside in the S&P 500 is really impressive, because ETFs or indexes like that tend to not gap or have big moves like that unless something really interesting is going on, because by their very nature, they're a diversified portfolio of stocks. Dow Jones Industrial Average, 30 stocks. S&P 500, 500 stocks. So they are by their very nature diversified. But my point is continuing to add reasons to be looking at, right? Continue to add clues. 5 bullish gaps is impressive and something we need to pay attention to. So that's more reason to be looking at some ideas. Now, we have to be careful about buying for the sake of buying, because there's a lot of stocks that have just kind of rocketed higher and they're not at what we might call an optimal entry. Now, an optimal entry, for those of you that might be new to our channel, an optimal entry essentially means that if we buy right now, is the reward that's left in the trade still available? So in other words, if a stock normally moves $10 and you're about to buy that stock, is the next likely move that full $10? Or let's say it's $10 and the stock has already rallied $7. You might be like, man, I can't wait to get involved in this stock. It's going up. Why wouldn't I want to get in there, right? But from a risk reward perspective, you're probably risking 3 to make 3, as opposed to risking 3 to make 10. So timing that part of the trade is a skill that you want to learn. And if you've been a part of our community, you know that easy, basically, trading is a lot easier than probably making it when you understand pushes and pauses. A push is where we make the money, which is that average move I just explained to you. A pause is where we manage risk and reset risk reward. So remember, reward is awesome, right? That's the whole reason we're trading, but we want to accept the right risk for the likely reward. So if you keep circling back to everything that we're talking about here today, all we're really doing is we're looking for reasons to be buying certain stocks. And then we go to those stocks and say, are we near an optimal entry? That's really what it comes down to. And then basically you start to map out which ideas make the most sense based on the optimal entry. So I want to be clear about this. And this is a big mistake that I see people make. Just because stocks meet scanning criteria. So let's say that you're using something like Finviz and you're running your scans every day and you find all these stocks over the last week look great. That's just the scan. That's just stocks that meet the criteria. What we need to do is then say, is this stock that I like at an optimal entry? So in other words, a push, and now it's just sitting there waiting for the next move, right? So a push involved during a pause and then looking to make money during the push. So I'll give you an example. We have a couple of ideas that kind of meet this criteria today. I'll give you a couple of charts. So Dell, obviously, from last week was one of the ones that we've been watching. But if you can actually take a look at, and I'm going to come back to those stocks in a second, this guy right here. So EQR, a real estate stock, has pulled back, right? you can actually see WPC, or another real estate stock, has paused. And well, as we just mentioned before, is way beyond the optimal entry. Abercrombie and Fitch sitting at a triple breakout right in front of all-time highs. So essentially what we're looking to do is we are looking for new ideas. Victoria's Secrets this week, right? FCX broke through 56. Excuse me, not 56, 52. So what we're looking to do right now is we are looking for stocks that are resetting an optimal entry, best case scenario, in the sectors that we just talked about that have the strongest bullish stacked order flow. So the market's strong. We found strong sectors, which right now is technology and real estate are really at the top of the list for us right now. And then from those two things, where we built the foundation underneath the idea, now we go up and say, within technology, are there any industry groups that have a larger number of stocks that are doing the same thing? Meaning, do they have stacked order flow? And in this case, yes. Semiconductors, which I don't know if you saw the chart of AMD. AMD actually has now, after getting beat up for a while, is now clearly broken this downtrend, and we're looking for a new move to the upside. So we kind of worked our way from the bottom, where we're looking at the Dow Jones Industrial Average and the S&P 500 and the QQQ as well. We'll talk about that in a second. Then we went up to which sectors are doing the same thing as the market. So again, we're stacking reasons to be looking at this idea. And then we said, are there any groups of stocks that meet those other two criteria that are kind of moving in a pack together? And that's where we kind of worked our way into semiconductor stocks. So I'm looking at semiconductor stocks this week as one of the groups of stocks that I'm watching. Now, there happens to be another group of stocks, but the stock that's reporting earnings today. So let's actually take a look at that right now, and that's PANW. Now, PANW, if you took a look at some of the bullish stacked order flow that we were looking at before, moves very, very well with two other stocks, PANW, CRWD, and ZTS. Those three stocks move very, very well as an industry group pack, right? Why is that important? Again, I want to keep bringing it back to not just saying it is important. Why is it important? If we go back to what we said at the beginning of today's video, we talked about how institutions move stocks up and down. So it's our job to find the stocks that have institutional attention. Well, how do we know stocks have institutional attention? With the amount of money they spent. So when they are moving in the same direction longer and persistently, and multiple stocks in that same group are seeing that same attention, well, you bet your bottom dollar that's where I want to have my attention. So if we take a look at PANW, which is scheduled to report after hours today, you can see that this stock has now clearly, after getting beat up over here, one earnings season later, the stock is rallying. CRWD doing the same thing, and ZTS doing the same thing. Now, before we get some comments about this 3 days from now, these are stocks that are in my watch list right now, but I don't trade these stocks into earnings. I wait for the earnings to come out because I like to be sleeping well at night. So I let these earnings come out, and then I look for opportunities, provided that the earnings catalyst is in the direction of the stacked order flow. So I want to be clear. I'm not trading these today into earnings, but now I've mapped out for you and for me this coming week that these three stocks, provided that earnings by PANW come out bullish today, I'm going to be looking for opportunities in all three of them. Now, one other idea that I want to talk about, which, again, kind of getting back to the concept of institutional attention, is when a stock has increased volume after the stock has been out of play for a while. Now, I want to show you one big example, which is obviously GME, right? Now, we all know the reasons why GME and GameStop is in play right now. But what I want to point out is obviously this move was pretty amazing, right? And however long you were in it and whatnot, that's a whole other story. But could we have seen this before it happened? That's the thing that you need to be asking to yourself. And the answer is yes. And this is basically what you need to know. So if we take a look at this right over here, look at what the stock had done prior to this, which was pretty much nothing, right? The stock was kind of in the doghouse, not much going on. But then all of a sudden, after it hit these lows, 2 days of massive volume. Now, we actually perked up a little bit over here, But this one day right here, or even this day, you might be like, oh my gosh, I missed a move, right? Well, first of all, you're not going to miss it if you're scanning for it. So you need to have a scan at the end of every day looking for what we would call accumulation type days or distribution if you happen to be long. Now you might be saying, well, oh man, it went from 1050 to 1650. I missed the whole thing, right? No, this is what is going to separate you from everybody else who misses these kinds of moves. This stock after we noticed the accumulation, went sideways for 2 more days, actually 3 more days. So the stock actually paused for 3 days after it had attention. These are the kinds of things that we need to scan for, track, and trade on. So just to give you an idea, again, this is what's so important. We actually do track this every day, and that's why it's really important. So those are the ones that meet the criteria today. So why am I bringing that up? Number one is there's another stock that this happened to recently and happens to be one of my favorite stocks to trade, which is Oracle. Oracle has not really been in play for a while. I love to trade this stock, but look at this. Out of nowhere, a giant green candle, which means institutional attention. Real money was put into that stock, and we got follow through. So is Oracle a buy today? No. It's 4 days after the optimal entry. So I am looking for a new trade in Oracle this week, maybe later in the week, but I want the stock to pause after that institutional attention to set up a new optimal entry so the reward potential justifies accepting the risk. So the point that I want to get across here to everybody today is that trading is probably 50 times easier than you're making it right now. You're probably trading predicting, you're probably forecasting and emotion and spur of the moment and all those kinds of things. Everything I just showed you is systematic. None of it is guesswork. It's here's what I'm looking for and how many places can I find it? And how do I know when it changed? That's a pretty simple way of trading. And when you kind of map things out that way, all the stress in trading goes away, and it's much easier to be consistent because you know how and why you made money in the first place. If you are frustrated in the market and you just can't seem to get ahead, maybe you make 1,000, lose 1,000, make 2,000, lose 2,000, it's because you're not trading in a systematic way. You're trading in a spur of the moment way. And you could never pop that thing into an algorithm and say, okay, back test all these spur of the moment decisions and tell me how I'm going to do. That's not how big money is made. Big money is made by making things systematic. Okay. And hopefully it was showing you, again, if this is the first time you're a part of our community, watch this video more than once, write down as much of the stuff that we talked about today, because this is really what I do for everybody every day. If you haven't been in my community, now is about the best time you can get in there. If you want to learn more about it, there's actually a link in the description if you want to learn what it's like to actually watch me trade for a couple of weeks and get a lifetime access to a course that I just built that has literally everything. You don't have to watch all the courses. It's got like the best of the best in those courses. So if all this kind of stuff fascinates you and you really want to just make things easier for you, trade in a more specific way, systematic, that's the key word. Just really think about whether or not you're doing that right now. And if you want to learn how I do it, you can click down in the description. So big week coming up this week. I want to touch on one other thing too, because this is really important, which is economic data for the week. So if we kind of work our way over to the economic calendar, we do spend a lot of time looking at the coming week and say, are there any big announcements that might make me want to reduce my position size? Because if those announcements come out, they could rock the market, right? We're not actually seeing this right now. Right now, we have the FOMC minutes coming out on Wednesday. Powell spoke yesterday, didn't really do that much, but really the FOMC minutes, pretty much the rocking thing that could move the market this week. There's really no GDP announcement this week. There's no inflation data this week. That was last week. No big jobs numbers this week. So for me, if we were all sitting on my trading floor in New York City, I'd be saying, you know what? We got a 3-day weekend next week with Memorial Weekend. No really massive economic data this week. I would feel pretty confident trading this week and getting in there and mixing it up, because I'm not looking over in the rearview mirror saying, oh man, there's inflation data coming out on Wednesday or something coming out on Friday. So I'm going to challenge you this week without all of those big economic data, other than Nvidia earnings, which is obviously important on Wednesday. This should be a pretty fun week of trading. So kind of map out systematically how you look for clues, and then just say, do I see the clues I'm looking for? and how many of them. The more you see, the more conviction. The less you see, pour another cup of coffee and preserve your capital. Sometimes the market's awesome, and sometimes the market is, it's kind of in the middle of nowhere, or it's going down. We reduce our risk when there was less clues, and we increase our conviction when we keep stacking more clues, and we happen to be at the optimal entry, like a few of the ideas that I showed you before. Trading is very easy. If this stuff is new to you, trust me when I tell you this, I could teach you all of this in just a couple of weeks, but you need to write it down and you need to know what you're looking for. So here's the big thing I want you to leave with right now. When you know what you're looking for, you're never lost. So for those of you that might be overwhelmed, confused, or the market just seems so chaotic, it just means you're not sure what you're looking for and you're trying to read everything. So when you kind of filter it down to say, this is all I'm looking for, the market becomes dramatically easier, because you can literally then say, here's what I'm looking for, and it's there. Great. Now let's look for an opportunity. The other side of that is, here's what I'm looking for, and it's not there. And that's the problem that a lot of traders have. They know what they're looking for, it's not there, and they're trading anyway. So when you reduce those unforced errors and you stay away from market conditions that don't make sense, you immediately become closer to net profitability. Then the next best thing to learn is what we call the profit maximizer, which is learning how to hold on to your winning trades a lot longer. We all get into the same trade, but we can have 50 different exits. When you have a systematic way of managing profits, oh my gosh, that's when trading becomes so much more fun, because you have little losses and you understand how to make the bigger wins, because you're looking for clues and you have a systematic way of hanging on to those winners. So I try and teach as much as I can during these calls, because I really want you to get the most value out of them. If we did a good job today, please do me a favor, hit that subscribe button. If you have any follow-up questions, leave a comment below the video. I promise I'll get back to you as soon as I can. And if you want to learn how I do things, again, click that link in the description and learn about how to get involved with me. You can come and watch everything I do, all that kind of stuff. Actually, I want to answer Tom here. That's actually a great question, and Simon actually did actually answer that for you too. So the 4 parts of the strategy are order flow, which is it obvious? Do stocks have institutional attention? Tape reading is it still valid? Which is actually the question that Tom just asked. Then you have the optimal entry and the profit maximizer. So write that stuff down. And if you have any follow-up questions, leave those comments below. If you want to learn and trade with me for a couple of weeks, click that link below as well. It's in the description. All right. Have an awesome week, everybody. This should be a pretty good week of trading. Nvidia earnings coming out Wednesday, scheduled to come out on Wednesday. Have an awesome day. Thank you so much for joining me.